Let's talk about money, the kind that grows while you sleep. I know you want it. I like it. It's great. Mutual funds, index funds, ETFs. You've heard the terms, maybe even used them, but can you really explain the difference? Or are they as confusing as trying to explain the plot of Inception? Let's be honest, we've all fumbled that one. So here's the truth. Understanding these investment tools can feel like navigating a mirror maze. Familiar terms, but every path seems to lead somewhere different. And the stakes, they're huge. Choosing the wrong one can cost you thousands in fees or misguided growth. But don't worry, I got you. I'm a former contract CFO, and in this video, we're breaking down mutual funds, index funds, and ETFs, baby. By the end, you'll know exactly what they are, how they work, and which one fits your investing goals the best. So whether you're just starting out or ready to level up your portfolio, this guide will give you the clarity you need to make confident decisions. So smash that like and let's get going. Number one, mutual funds. Mutual funds are the grandparent of investing tools. Reliable, experienced, and maybe a little old school. They first appeared in the 1920s as a revolutionary way to give everyday people access to the stock market. And it really was revolutionary. It leveled the playing field with Wall Street pros. Before mutual funds, building a diversified portfolio was nearly impossible for most investors. They made investing accessible, and for that, they've earned their place as a classic. What exactly is a mutual fund? Well, imagine a big pot of money filled with contributions from hundreds or even thousands of people. That pot is handed over to a professional fund manager whose job is to decide where to invest it. Stocks, bonds, a mix of both. It's like hiring a chauffeur for your investments. Someone else takes the wheel. They're managing the investments while you sit back and hopefully watch your money grow. For example, a mutual fund might hold stocks like Apple, Microsoft, Amazon. If the fund manager thinks Google's no longer a good fit, they can swap it out for Johnson & Johnson to try to maximize returns. This hands-on approach allows mutual funds to respond dynamically to market changes, which can be a huge advantage. So, what makes mutual funds popular? Well, first off, professional management. When you invest in a mutual fund, you're hiring a team, not just one person, a team of experts to manage your money. These professionals spend their days analyzing markets, researching companies, and making investment decisions on your behalf. For beginners, or those who don't want to spend time managing a portfolio, this can be a game changer. Second, diversification. See, mutual funds provide instant diversification, spreading your money across dozens or even hundreds of different companies and different investments. This reduces your risk because if one stock tanks, others in the fund can help cushion that blow and hopefully offset it with some growth. It's like having a financial safety net built into your portfolio. And third, reinvestment opportunities. Many mutual funds allow you to automatically reinvest dividends and capital gains. This means that your money is immediately put back to work, compounding your investment over time. It's like having your portfolio on autopilot for long-term growth. Now, despite their benefits, mutual funds aren't without flaws. Fund managers don't work for free, and their annual management fees typically range 1% to 2%. And over time, a 1% to 2% fee adds up. So for example, a $100,000 investment might cost you $1,000 or $2,000 per year, money that could otherwise be compounding in your account. And here's the unfortunate truth. Even if the fund performs poorly, you're still paying those fees. Studies showed that around 90% of actively managed mutual funds fail to consistently outperform the market. So while active management sounds all drippy and flossed out and awesome, the reality is that most mutual fund managers struggle to beat index funds, which simply follow the market. Now, mutual funds may be the traditionalists of the investing world, but they've earned their spot for a reason. They offer professional management, instant diversification, and hands-off investing, making them a great choice for beginners or anyone who values simplicity. However, their high fees and inconsistent performance mean they're not for everyone, i.e., they're something I personally despise, okay? So if you're looking for a cheaper, simpler option that still delivers solid returns, stay tuned. Next, we're diving into the sleek and efficient world of index funds. But first, I'm asking you to help me reach more people on here by smashing that like. And if you're enjoying the content, please subscribe with your notifications turned on so you don't miss a video. It really does help the algorithms when subscribers watch videos and you smash likes. Index funds. If mutual funds are like hiring a chauffeur to drive you around, then index funds are the self-driving car of the investing world. No human decision making, no trying to outsmart the market, just a simple, efficient system designed to deliver steady, reliable results. And for most investors, that's exactly what they need. So what's an index fund? Well, think of it as a basket of stocks or bonds that follow a specific market index. A market index is like a playlist of companies that represent a segment of the economy, such as the S&P 500, which tracks 500 of the largest US companies, including giants like Apple, Amazon, Coca-Cola. When you invest in an S&P 500 index fund, you're basically buying a thin slice of all of those 500 companies. It's an instant diversification on a platter. Index funds were pioneered by Jack Bogle, the founder of Vanguard, in the 70s. He was frustrated by the high fees and inconsistent performance of mutual funds. So Bogle introduced a game-changing idea. Instead of paying fund managers to pick stocks, why not just mirror the market? This approach eliminated the need for active management. It slashed costs and opened the door for everyday investors to grow their money efficiently. One of the biggest advantages of index funds is their ultra low fees because they're passively managed, which means the fund simply tracks an index. The cost of running them is very minimal. So for example, an index fund might charge just 0.04% annually. Compare that to the 1 to 2% fees typical of actively managed mutual funds. Over time, those savings can make a massive difference in your returns. Another advantage is their consistent performance. While mutual funds aim to beat the market and often fail, let's be real, index funds are content to match the market. Historically, the stock market has grown by 7 to 10% per year after inflation. By riding the wave, index funds deliver steady growth with minimal effort on your part. They're also tax efficient because index funds don't trade stocks often. They generate fewer taxable events like capital gains distributions. And this means more of your money stays invested and compounding, growing over time. And speaking of compounding, that's where index funds truly shine. By reinvesting dividends and letting your money just grow, you can churn even small contributions into a sustainable nest egg for you over the years. But let's be real, index funds aren't perfect. They can only be traded at the close of the market for each day. So you lose the flexibility to buy or sell during market hours, but that's really more trading. And while they're great for tracking the market, they won't beat it. So if you're chasing sky-high returns, index funds might not satisfy that itch. Still, it's no surprise that legendary investors like Warren Buffett swear by index funds. Buffett once bet $1 million that an S&P 500 index fund would outperform a group of elite hedge funds over a decade. The result? The index fund crushed the competition. For most people, index funds are the ultimate set it and forget it, baby, investment. They're simple, they're cost efficient, and they're proven to deliver solid returns over the long term. So if you want your money to work harder without you working harder, index funds are the way to go. And speaking of hardworking investments, let's take a look at ETFs, the flexible and modern cousin of index funds. So if money and investing seems a bit confusing to you, grab my masterclass on money at the link below. It's absolutely free. It wraps everything I've learned over 15 years of study and application in the world of money. So ETFs. If mutual funds are the traditionalist and index funds are the minimalist, ETFs, short for exchange traded funds, are the modern multitasker. These investment tools combined the best of both worlds, the diversification of mutual funds and the low cost of index funds and the flexibility of individual stocks. It's no wonder they've skyrocketed in popularity since their debut in the 90s. So what exactly is an ETF? Think of it as an index fund you can trade like a stock. ETFs track a specific market index like the S&P 500 or the Nasdaq, and they give you the exposure to a wide range of investments in a single purchase, But unlike mutual funds or index funds, which can only be traded at the end of the day, ETFs let you buy and sell shares throughout the day trading. You got your eye on an ETF that dips in price at 11 a.m.? You can snag that bad boy up while it's down. ETFs are incredibly cost effective, often boasting even lower fees than index funds. For example, some ETFs, they charge as little as 0.03% annually. And the best part, you don't need a fortune to get started. See, if an ETF is priced at $50 a share, you can begin with just $50, or even less if your brokerage offers fractional shares. This accessibility makes ETFs an excellent choice for beginners and seasoned investors. Another standout feature of ETFs is their flexibility. We can trade them as frequently as we want, which is a blessing for hands-on investors. You want to take advantage of short-term market movements? ETFs have you covered. Prefer a longer-term strategy? They work for that too, baby. But this flexibility can also be a double-edged sword. See, the ability to trade throughout the day, it might tempt some investors to trade instead of invest, which can erode returns over time. ETFs are designed to track the market, not beat it. So impulsive buying and selling, it won't do you any favors. See, ETFs are also incredibly diverse. You can find one for nearly every investment theme. Broad market indexes, specific industries like tech or healthcare, geographic regions, or even emerging trends like clean energy or crypto like Ethereum and Bitcoin. Whatever your investing goals or interests are, there's likely an ETF that fits it perfectly. Another win for ETFs is their tax efficiency. Unlike mutual funds, which can trigger capital gains taxes when they rebalance the portfolio, ETFs minimize taxable events by using a process called in-kind exchanges. This means you can keep more of your money working for you, and ETFs are perfect for investors who want flexibility, low fees, and a wide range of choices. Whether you're just starting out or looking to diversify an existing portfolio, they offer a versatile and modern approach to investing. So how do mutual funds, index funds, and ETFs stack up? Mutual funds are great for hands-off investors who value professionally managed and don't mind paying higher fees that reduce your growth. Index funds offer simplicity and low costs, making them ideal for long-term, set it and forget it investing. And ETFs, they're the perfect choice for those who want flexibility, accessibility, and a customizable investing experience. Look, investing doesn't have to be complicated. Whether you prefer the classic approach of mutual funds, the simplicity of index funds, or the flexibility of ETFs, each tool offers unique advantages to help grow your wealth. The key is finding the one that matches your goals, your style, and your vision for the future. So if you're new to investing, start small. Pick a fund, set an automatic contribution, and let time and compounding do the heavy lifting. And remember, the best time to start was yesterday. All right, the next best time, right here, right now, baby. If you found this video helpful, don't forget to like, subscribe, and hit the notifications bell for more no-nonsense financial advice. And let us know in the comments, which investing tool do you think fits your style best? I appreciate you watching. As always, you, my friend, you keep living your life to the fullest, and I will see you in the next video, right here or here. Peace.